ever wondered how some real estate investors seem to have an endless supply of funds for their projects? Well, it's not because they're all millionaires. Many of them are using something called a hard money loan. Getting a traditional loan for a real estate investment can be a long and tedious process. So for many investors, time is of the essence, so they can't just use a traditional loan. And that's where hard money loans come in. They're a quick and efficient way to finance your real estate projects. Now, you might think that getting a loan requires having a perfect credit score and having a steady income. But with hard money loans, that's not always the case. So in this video, we're gonna dive into the world of hard money loans. We'll talk about what they are, how they work, and how you can use them to finance your next real estate investment. Now, I know a lot about this topic because I used to be a hard money lender for almost 3 years, and I've originated over $100 million to investors all over the country, many of whom have actually found me from this YouTube channel. So with my experience as a hard money lender, I'll be giving you guys insider tips on how to get the most favorable rates and how to make sure that you do what you can to make sure your deal goes through. I'll explain what hard money loans are used for, how the process works, and what questions you need to answer before your lender will even give you a loan in the first place. So without further ado, let's get started. So what is a hard money loan? A hard money loan is a special kind of loan for people who want to buy property fast but can't get a regular loan. So with a regular loan, a big bank will ask you for your income details and your tax returns for the last 2 years. They also want to make sure that you can put down 20% for the down payment, and they're only going to lend you money for a property that's in good shape. But hard money lenders understand that most people who are buying these investment properties are looking for the ones that need a lot of work. People who flip houses aren't going to be buying pretty homes because they need something to fix up to make a decent profit. They also understand that many real estate investors don't have regular jobs. They make their living from investing in properties, so they may not have a W-2 to actually qualify for a conventional loan in the first place. Hard money lenders understand this, and they focus more on the deal itself and not necessarily on the person who is borrowing the money. They just want to make sure that you can actually make a profit from your projects. Now, the advantages of getting a hard money loan is that they're great because you can close relatively quickly, since they don't usually require a full appraisal on a property. The lender usually orders something called a BPO, also known as a broker's price opinion, to get a quick value estimate of the current value and the after repair value, also known as the ARV. Hard money lenders will also give you a loan regardless of your debt to income ratio. So that means that you can have a virtually unlimited amount of outstanding loans as long as each deal makes sense. It also means you're not capped based on your current income. So if your job doesn't pay you enough money to support the loan, it's okay as long as the deal makes sense. Now, a disadvantage and downside to a hard money loan is that you are paying a higher interest rate on it. So for example, if you got a regular 30-year loan from a bank, you might pay 6 to 7% interest. But with a hard money lender, it would be much higher, such as 10 to 11%. However, since these are typically interest-only loans, your actual monthly payment won't actually be that much higher compared to a conventional loan since you won't be making principal payments. When you're getting a hard money loan, also expect to pay processing fees and origination fees. You typically see processing fees in the $1,500 to $2,500 range, which is a flat fee regardless of the loan amount. And then you have origination fees in the 1 to 2% range of the loan amount, which scales as the loan increases. So if a loan is for $500,000, you'll probably be paying between $5,000 and $10,000 in origination fees. If you do work with a broker, expect to pay an additional 1% fee to the broker directly. Another downside is that hard money loans typically expire in 1 year instead of 30 years. So this means that you need to have a very good plan to buy the property, fix it up, and sell it within that 1 year time frame, or change it to a long-term loan within a year. Otherwise, your loan could run out and you'll need to either extend it or risk losing your property. But before they even give you a loan, they want to know some information about you. So like I mentioned earlier, hard money lenders don't need your income details or tax returns, and they don't really care about your debt to income ratio. But they do have certain things that they do need to know. When you reach out to a hard money lender, they're usually going to ask you to fill out a pre-screening questionnaire form like the one I have here. They can learn more about you and your deal. And if you guys want to follow along, you can click on the link in the description. All right, for the initial screening, they're going to ask for your first name, last name, phone number, and email, so they can contact you if they have any questions about the loan. They want to know what your investing type is. Are you buying this by yourself? Are you buying this as an LLC? Are you buying this as a corporation or a partnership? If you're buying the properties through an LLC or corporation, they're also going to want to see the paperwork for that. So during the processing phase, they're going to ask you for your articles of incorporation as well as your operating agreement. So this way, they can make sure that everyone on the loan is actually a member of the LLC. And if you're buying it with a partnership, they're gonna wanna see the partnership agreement between you all. During the due diligence phase, they're also gonna wanna check to see where your money is coming from, and they're gonna ask for your bank statements. Different hard money lenders have different rules about how they handle the source of funds. So some care that the down payment money comes directly from you, while others don't mind if you get it from another private money lender or another investment for the down payment. So you need to talk to your hard money lender and see what they prefer. Hard money lenders are also going to want to know your credit score. Now, some hard money lenders will check your credit and some won't. Generally speaking, the larger hard money lending companies that do billions of dollars worth of loans every year will often have the best rates, but they will also check your credit. Now, the higher the score, the lower your rate's going to be. And if you have a really low credit score, they might still give you a loan, but they're going to charge you a much higher rate to compensate. Now, there are also some companies who will give you a loan as long as you're alive. They won't even check your credit, but they'll probably charge you 12 to 15% interest as well as very high origination fees. So in the pre-screening form, they're going to ask you what your typical FICO is. There are 3 bureaus that calculate your FICO score, and they'll usually use the middle score. Now, of course, if you write an 800 on your FICO here, and when we pull your credit, it comes out to be at 600, then obviously they're gonna have to renegotiate the terms on you. So do your best to answer this as accurately as possible. Next thing they're gonna ask you is your real estate experience. Experience usually means how many deals you've had in your name over the past 2 to 3 years. So if you were a wholesaler, a real estate agent, or a contractor who worked on the property, but you didn't actually own the property, like your name is not on title, then most lenders will not count that as experience. But if you're a real estate investor who happens to own a lot of properties as rentals, then that usually does count as experience. So talk to your lender and see what they consider as experience. And typically the more deals you've completed, the more comfortable the lenders will be, and they'll also be able to give you lower rates for that. The lender is also gonna ask you how much you have in approximate liquid reserves. So liquid reserves is gonna be cash in the bank, any stocks that you have, and possibly your retirement accounts. But of course, they're gonna take a discount on those. So if you had $500,000 in retirement, they wouldn't give you $500 as liquid reserves because they know that if you try to use your retirement account, then you'd have to pay a 10% penalty plus 30% for taxes. So they'll probably take a 50 to 40% discount on your $500,000 in retirement. Now from that liquid reserves number, they're gonna see if you have enough money to cover the down payment, your closing costs, your renovation budget, and 6 months of holding costs. So why do they do this? Well, they wanna make sure that you have enough money to buy your property, fix it up, and hold onto it long enough without going broke. The worst thing that a lender can do is give you a big loan and then you just suddenly stop making payments after the very first month. So they always check to make sure that you have enough liquid reserves to do the deal successfully. So now let's talk about the property. They're gonna wanna know everything about the home, such as the property address, the city, the state, the zip code, what kind of property it is it a single family home, a condo, duplex, etc. Because different types of properties can affect how much they'll lend you in the first place. Single family homes are usually the easiest to lend on, very straightforward, and you can usually get the most leverage with these at the lowest rates. Whereas with multifamily properties and apartment complexes, you're gonna get less leverage and higher rates. Some property types are just straight up a no-go for most lenders. For example, most lenders may not touch condo hotels, also known as condo hotels, or they may not touch commercial real estate, such as strip malls or mobile home parks. Usually they'll lend for single family homes, duplexes, fourplexes, condos, townhouses, and so on. They're also gonna wanna know if the property is vacant or if there are tenants already living there. Because if there are tenants when you close, it's a little bit riskier because there are some areas that have rent control laws that prevent a new owner from evicting a tenant without cause. So this could cause an investor to fail, and it's not something the lender really wants to get involved with. The lender is also gonna ask you about the price that you agreed to pay and if there's any extra fees if you're buying from a wholesaler. Many people call hard money lenders before they have a set purchase price or before they have the property even under contract. And I do recommend talking to a hard money lender first to understand their rules, but I don't recommend filling out a whole pre-screening form until you actually have a contract or you're close to having one. Otherwise, you're just wasting everyone's time. So make sure you get something in writing first. Different lenders handle the extra fees like assignment fees a little bit differently. Some are okay with including it in the total purchase price, whereas some want you to pay for it yourself out of pocket, and some do a mix of both. As example, the company that I used to work for would allow assignment fees as long as the assignment fee was less than 10% of the purchase price or under $100,000. So if you're buying a property and the loan amount is for $500,000, but the assignment fee is for $100,000, they may give you $50,000 to handle the loan, but they may ask you to pay for the other 50% out of your own pocket. The lender is also gonna wanna know what's your budget for fixing up the property. If you're new to the whole process of flipping homes, have a contractor walk through the property with you before you make an offer. They can give you an estimate of the cost, and you can write this number down here. Lender will also ask you how long you think it's gonna take to fix up the property and what kind of work you'll be doing. Are you just updating the look, or are you doing major structural work? This will affect how risky the project and loan will be for the lender. They're also gonna wanna know what the approximate ARV is, or after repair value. Now, as an investor, you should be very good at figuring out the ARV because this will help you know if you're gonna make a profit on the deal or not. And this is also gonna help the lender see if your deal is good enough. If you guys need help figuring out how to calculate the ARV for your deals, let me know in the comments below and I'll make a video about that later. Now, if you're doing a very big project, they're gonna wanna know if the plans and permits have been approved. If they haven't, they know that you're probably gonna be holding on to this property for about a year before you can even do anything. It doesn't mean that they're gonna deny your loan. It just means that they know that you need more money to hold onto the property before you can fix it up. Another thing that they're gonna ask you is your desired LTV, or how much loan do you need to close this deal. They're also gonna ask if you do need a rehab loan. So many hard money lenders offer loans for the purchase price as well as the renovation budget. Newer investors are typically going to be limited to 80% of the purchase price, whereas the most experienced investors will be getting 90/100, which means they're going to get 90% of the purchase price and 100% of the renovation budget. Now, finally, the last thing they're going to ask you is for the closing date. This tells the lenders how long they have to work on your file and do all of the inspections and BPOs that they need to do. Now, if you can answer all of these questions, your hard money lender will love you. They'll think you're professional and they want to keep working with you. So from here, the lenders can put all of these numbers onto their spreadsheets and see if the deals make sense. They're going to check if the total loan amount is a good percentage compared to your ARV. They usually want to see that your loan amount is less than 70% of the ARV. So that means that you have enough room to make a profit on the deal. A hard money lender probably won't lend you money on a deal if they think you're going to lose money. Because if you lose money on a deal, then you probably won't do more business. You might miss payments and they might have to foreclose and take your property. And most lenders are not in the business of doing that since it costs a lot of money and time to do so. Now, based on this questionnaire, you can probably guess the best ways to get the best rates, right? The way to get the best rates is to have a really high credit score and have as much real estate experience as you can. Every company has different ways of ranking people, but generally speaking, you tend to get more favorable rates if you've had over 5 projects over the last 2 years, and the best rates if you've had over 20. So the more deals you do, the better rates you're gonna get. Obviously, the more money you have, the more comfortable they're gonna feel with you having a loan in the first place. So they may be even willing to lower your rates and fees. Also, if you ask for a lower LTV than the maximum they'll give you, then they can give you a low rate on your loan as well. So if you're looking for the maximum, which is typically 90% of the purchase price and 100% of the renovation budget, then you'll be paying a much higher rate. But if you only need 80% of the purchase price and no renovation budget, then they can lower the rate for you and be more aggressive with their loan terms because it is a safer loan for them. And of course, and this is very important, if you're a chill person and your loan officer actually likes you, then they can work really hard on your behalf and offer you discounted processing fees and origination fees. But if you're an arrogant douchebag who likes to yell at everyone when things don't go well, then don't expect any favors from your lender. So treat people very nicely. And if you guys are actively looking for a hard money loan, I recommend checking out Conventus Lending. They're a hard money lender that can originate loans in most of the states across the country. This is the company that I used to work for, and I've actually used them for most of my own flips. They've helped thousands of investors with their real estate project and originate over $1 billion a year in loans. If you guys are interested in getting a hard money loan with Conventus, you can submit your deals using the short form that we've been using for this video. Now, once you submit, someone from their team will reach out to you to follow up with you and give you a loan. And if you tell them you came here for my video, you can actually get $500 off of your processing fee for your next loan. I hope this video was helpful. If you have any questions about hard money loans, then feel free to let me know in the comment section. And now that you know how to get a hard money loan, the next thing to consider is how to know if a deal is good or not. Now, if you guys want to understand the market and calculate potential returns, then check out this video on how to analyze a rental property for beginners in 2023. Thanks for watching, guys. I appreciate you, and I'll see you next time. Take care.